What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 20th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, and or at least I hope you're hanging in there because I know the market is a bit crazy at the moment. Crypto prices are down across the board. Bitcoin down over 10%. It's the worst day we've had since as far back here as June 13th during the peak capitulation candle leading into the tail end of the sell-off in the mid part of June. So I think a lot of people are wondering what's causing this. This really has come out of nowhere. Crypto markets have been relatively non-volatile, and especially in cryptos like Ethereum, trending up over the past month or so. So I want to go ahead, spend some time to break that down, talk about what I'm doing, what we did just this past week, and what we talked about on the channel. And also, we've got a sponsored review of the Radix protocol, one of the big layer 1 plays that we're actually excited about outside of Ethereum and all this talk around the merge. So I'm going to be talking about some of my vision for the company or the project long term, and outside of that as well, some of the exciting developments coming down the pipeline. But I want to go ahead, before we do that, and just kick off here talking about crypto. And what better way to do this than for those of you who might have been around as far back as 2017, as I'm back here at the original studio, or my original house I was staying at during the initial parts of my videos. So very fitting here. It's crazy. It's been over 5 years we've been here on the channel. But enough rambling. If you guys happen to be one of those viewers, drop a like, leave a comment, and let's go ahead and kick things off. So I want to go ahead and talk a little bit about what we discussed in our previous video. As some of you might recall, in our previous update on Wednesday, we talked a little bit about what's known as the Fed meeting minutes. And these are essentially a release of thoughts from various members of the Federal Reserve. There's also a speech as well from Michelle Bowman, who's also one of the Fed, not the Fed chairman, but one of the other Federal Reserve governors who helped contribute to the conversations and discussions around monetary policy. But all these thought leaders within the Federal Reserve and their various branches across the country are presented within these documents. And you get a mix of different thoughts and different concerns and weights about what might be the right decision in the future. Nothing directly finite, but at least summarizing the thoughts of what were happening back in July and a little bit of what we're looking forward to going into the future. Now, I know this doesn't sound like it has to do with crypto, but it has everything to do with crypto. And this is why, again, on this channel, as we've been doing as far back as really 2017, 2018, but really been emphasizing over the past couple of months, is focusing on the macro perspective of what's going on outside of crypto. Because if you're just watching the charts and just expecting the crypto is just going to go up because of how great it is or how much value you see in it, the fact of the matter is we need to understand what the monetary flows are going to look like. Are more people going to be buying crypto or selling crypto over the next few months? If there's more buyers than sellers, then price will go up. And if there's more market sellers than market buyers, price will generally go down. And a lot of this has to do with the monetary policy decisions of the Federal Reserve that are going to either establish a risk-on or risk-off environment. Risk-on meaning the Fed might start to lower interest rates once again or stop the growth of interest rates and possibly even stop tapering their balance sheet or lowering the amount of assets on their balance sheet and starting to reverse and maybe add assets or keep it where it is. And vice versa. If the Federal Reserve continues to raise rates and continues to tighten its balance sheet, that is going to constrict credit and the amount of money in the system, and therefore it is going to weigh down asset prices like crypto. And that's why on Wednesday we talked extensively about how this Fed meeting minutes event, which not too many people were watching, they usually think that the FOMC meeting where the Fed actually makes these decisions and maybe I guess some of the numbers like the CPI are the only ones you should watch, but this is why an economic calendar, a lot of which are free online, is so valuable, and you can know when these events come up. And when we got that release, while it didn't manifest in price immediately, we started to see in equity markets a very clear pullback, which then again followed through in crypto markets here over the past couple of hours. If we dive into the hourly chart, brutal downward candle here, and as we saw price continue to fall through here. Now, of course, at the end of the day, I want to go ahead and point out something that I think a lot of content creators don't talk about, or market analysts for that matter, even in traditional equity markets. The fact of the matter is, when we ask the question why Bitcoin is down, it's because, back to our original statement, more people are selling than buying. There is clearly someone in the market right now who, for their risk profile, feels that they needed to sell a large portion of Bitcoin. Obviously, very clearly, someone started this kind of catalyst sell-off here and there's been continuation through. But I want to go ahead and explain again why on a substance basis this makes sense. Because all the while, we've seen Ethereum rallying up from $800 something all the way up to 2,000. We've seen Bitcoin continue to make higher lows and higher highs. I got to tell you guys, whereas Ethereum's been quite strong, it started to look exhausted over the past few weeks. And Bitcoin as well, which really should be leading the pack as the largest cryptocurrency in a generally risk-off environment. If anyone's going to be leading, it should be Bitcoin, even putting aside our fundamental analysis of what the merge might bring for Ethereum. Bitcoin should be leading the pack because it's the largest crypto, and in a risk-off environment or the start of a new bull market, which many people thought we were stepping into, Bitcoin should be leading the way. But it wasn't. It was showing incredible signs of weakness. Every time Bitcoin's price would tick up, you'd have a follow-through of about 6 to 7 days of slow red candles. And the higher lows and higher highs, while obviously indicative of a trend, they were not incredibly confident. And if we're looking back at this chart here, especially comparing today's sell-side event, you can see just how much Bitcoin's price was signaling weakness ahead of time. And we warned about this extensively. For the past few weeks, we've been talking, for the previous month, we were talking extensively about the relief rally, right? We rode that really well throughout July. We made some great trades. We took advantage of it, reduced some of our losses. Again, didn't get caught 2 steps behind, took advantage of that time. And at the same time, over the past week, we've been really emphasizing on the channel, since I think as far back as late last week, that we are getting likely towards the tail end of this, that with the Fed meeting minutes, this could be a macro event that could really spark this. And just taking a look at the chart here, it's not just Bitcoin. Ethereum slammed down over 12.8% here, getting knocked down over the past week from its previous highs at $2,000, coming down here towards around $1,600. ETH BTC ratios we talked about the other day started to look exhausted. It's getting up towards the previous range where we usually started to set temporary highs in price, and now with the daily candle we had here, this looks like a further confirmation. But again, take a look at equity markets. Now, some of you will also remember, for those of you who watch the channel religiously, we had a big target, and we shared this with the Dash Report alerts group back about a month and a half ago. Sorry, I'm stuttering a bit, guys. A little bit late here on my end. I'm doing a late night video. It's technically the 20th here, but I'm doing it before I head out for a trip tomorrow. But we had talked about essentially this price target of around 13,500, and 13,500 was a price point we had back here in early July for a relief rally in the Nasdaq 100 to come back up towards the line that could be drawn between the two previous relative highs. Here around December of 2021, around 16,600, 700 points. Here around 15,200, leading down towards a nice clear line at around 13,500. And that was a pretty typical relief rally target. We considered previous historical returns of relief rallies, and we thought, this isn't a time to get bearish. If you've got liquidity on the sidelines, take advantage, ride the strength. But a lot of the traders that I really admire out there, and I think this is something, again, some people might be embarrassed to say, I think it's something that I say with confidence to a degree. I love following a lot of other traders and investors, like humbling myself and feeling, hey, what are you guys feeling about the market? What are you thinking about the current status of things? And the thing I hear from a lot of people is that a lot of their signs haven't flipped on. The bull market's kicked in. And if you've been listening to anyone, many of you might even be in the scam, not meaning to cause any judgment. I've fallen into the same trap as well. A lot of people were really excited about the merge. Many people thought that the Fed was going to start to pivot in monetary policy. And when you have these new technological innovations on the cusp, when you have rumors that the Federal Reserve might be able to start reversing course and stimulating financial assets once again, everyone starts to perk up. They start getting excited. They start risk-taking. They start thinking the good times are going to come rushing back. But as we talked about extensively on this channel, not only is it not good to get optimistic, of course, in a generally risk-off environment where there are still a lot of fundamental issues, primarily inflation-driven, but on top of that as well, with rates going up over time, this is going to cripple consumer demand over the next coming years. And unfortunately, it's essential because we need to cool that consumer demand to cool inflation. But consumer demand still has not cooled down enough. The Federal Reserve as we saw through those meeting minutes, irrespective of the merge in Ethereum and all these great technological innovations, the monetary policy outlook is mixed. And that is not what the market was looking for. You can clearly see that reflecting in equity prices over the past few days since that meeting back on Wednesday. Since back on the 17th here, we've been slowly ticking down here with momentum building up. And what we've essentially seen is not only a failure to hold on the 200-day EMA, right? This was the range we had talked about where you're going to get some contestment in price. And, I'll be honest with you, I thought we'd at least see an attempt to bounce off of here. But the incredible thing is that it's rolled over even faster than I anticipated. And now with us deviating here above the previous line of resistance and rolling back over, this likely means we are at a minimum going to revisit down to the lows of the previous support range, if not potentially setting new lows in the coming months. Now, I want to go ahead and speak a little bit as to why this could potentially happen here. I'm not saying it's guaranteed by any regards, while we have been very confident on the relief rally and at least a short-term cool down here in financial markets following the meeting minutes and the inevitable decision that the Fed is going to have to make in September on monetary policy. I want to go ahead and take a look at some of the charts that are going to tell us what the Fed is going to do in September. They are going to tell us more truth than equity markets, more than anything. Any kind of betting or betting markets or indicators, what can essentially tell us what the Fed is going to do here, right? Now, the equity markets are starting to price this in here off of this news. But you want to know what was telling us the answer well beforehand, before the S&P 500, before the NASDAQ, before the total market cap in crypto, when we got this clear resistance here of this past week here, previous support. The things that were telling us this were the dollar index. As far back here as August 11th, when we started to see this bump out here of the ascending support range. And once we got in here to the 17th, afterwards just continuing to make more than 0.5% return each and every day in the dollar against global currencies. And what this signals, alongside the next chart we're going to be talking about, the U.S. 30-year yield, the yield you get on 30-year Treasury notes for the U.S. federal government. Since back here on August 2nd, the bond market, which is hyper efficient and hyper predictive of what the Federal Reserve is going to do, yields have gone up from 2.9% to 3.2%. All of this was letting us know that the smart money knew exactly what's going on. While equity markets were yet again speculating, crypto markets were starting to churn higher. People were estimating that we've got the technology that's going to get people excited again. The Federal Reserve is going to be the fuel to the fire. They're going to essentially pivot. They're going to start lowering interest rates or lowering the growth rate of interest rates. They're going to stop touching the balance sheet. And is this just going to allow for another bull market to happen, right? Well, unfortunately, not only is that just not how it always works, but on top of that, the Federal Reserve has no room to essentially pivot like they've done in the past. Everyone has gotten so used to the sugar rush of the last decade, where they think that any time that the NASDAQ or this general stock market pulls back, that when we come down to the 200-week moving average, like we historically do from time to time over the last decade, that this is going to be the ultimate buy point for equities. And while I don't want to disregard that this is definitely a more fair value range to start acquiring equities, people do not understand a lot of the time, because they just don't zoom out enough, that we have had periods where we revisit this 200-week moving average, we bounce off of it, have a dead cat bounce or relief rally, and then we eventually come back down to break through it and have a much larger extended recession. And I got to be honest with you all, the key point that you at least need to understand is that that is a possibility. I don't want to speak in absolutes. I'm no guru. I don't know what the Fed's going to exactly do at their next meeting, but I got to be honest with you all. I think the painful reality that many people have unfortunately ignored is that they've likely got a 75 basis point hike going. They are still maintaining course. Just because oil and natural gas have cooled down for a couple weeks now, and have been really, the highs were set back in at the earlier part of this year, doesn't mean that inflation isn't still crippling people. It doesn't mean that there is still not a massive gap between income and expenditures. And unfortunately still, even with these issues, it still doesn't mean that the Federal Reserve has to not cool demand, because there is still a lot of demand comparative to supply for a lot of the things that have been driving inflation, albeit things like commodities, of course, but on top of that, properties, all kinds of things that are adding to the cost of living. And this is what, unfortunately, pretty much guarantees that equities and assets like crypto are not going to do well, because crypto and assets generally serve as vehicles or conduits for people to be able to take money that they have here today and park it away somewhere. They trade it for an asset like Bitcoin, hoping that the value is going to go up over time. They're aiming to use it as a store of value, something that will at least at a minimum retain the original value and hopefully make some returns on top of it. Now, we understand that store of value is a subjective term, right? Obviously, crypto is very volatile, but the same goes with equity markets. All of them are still seen as a way, though, in the long run of being able to protect value. And unfortunately, this is something that passive investors and people who, again, started investing during this last great, more than decade-long bull run in equity markets or in crypto, they've gotten used to this idea that you can just simply buy the dip. And while that has worked in the past, because the Fed could always just pivot, they could just lower interest rates again or add to the balance sheet as they did through multiple rounds of QE, they do not have those tools available to them. Because if they do that, that demand that they are trying to tame in order to tame inflation is going to come roaring back. And therefore, as a symptom, inflation is going to come flaring back once again. So what you've got now is not only an environment where equity prices and generally assets overall are going to be hanging very close to that 200-week moving average at a minimum, but on top of that, there is a very good chance that, like the dot-com bubble or like the 2008 recession, albeit maybe it's not as dramatic, maybe we don't get the full 50% correction, that we are likely going to get at a minimum a 40% correction. And the areas that have excelled over the last few years, crypto, technology companies like Facebook and Netflix, right? And all the tech startups and IPOs, all those things that led over the past decade, they are going to get crushed because many of them are not cash positive or are living with aging, dying business models, lacking innovation, and they're in an environment where monetary policy is not favorable. That is not the kind of signs I want to see going into the market. I want to see that I'm entering into an environment where I'm going to get rewarded for my risk taking. In this environment, I feel like every time I'd be buying into something, someone's selling on me. Someone's selling their positions. They're going into cash. They got more expenses to live with. And they know that the smart money is not buying, and there's not as much retail money. There's not as much people just spending disposable income that they have. That's the kind of stuff that drives market cycles. And we just simply don't have that now, plain and simple. And with equity markets having their best relief rally here so far, much better than the one we saw previously back in March, albeit taking a little bit longer, but higher in percentage terms, and seeing this rejection and fall through outside of the 200-day moving average. Look, I don't want to say that it can't rebound and test up in this range a bit more. Nothing moves in a straight line. But to be honest with you all, as we talked about in the last video and over this past week, we're of the idea here that we're ready for a cool down. We need to see some kind of cool down in price. And that's why we've emphasized this idea of taking chips off the table, taking advantage of this rally. Unless you guys really, and this is something I always emphasize again, and I'll kind of close off this conversation before we dive into the conversation on Radix. Again, if you're a long-term investor and you're buying positions, you're dollar cost averaging, or you went all in on a price, on some price on an asset, whether it be Bitcoin or Ethereum or your favorite altcoin or favorite stock, and you're like, hey, Nick, look, I don't care when I buy it. This is for the next 5-10 years. That is A-okay. Good for you for buying on a dip. I applaud you for that. And not trying to absolutely time the market. No one really knows when the market is going to bottom or top. And waiting around is usually one of the worst things you can do unless you're, again, starting to employ dollar cost averaging and have the stomach to buy when no one else is willing to. That's what defines a great investor. But I think there are a lot of people, and I think we need to be honest with ourselves, who say, oh no, this is a long-term position. I'm in it for the long run. You got to ask yourself whether or not you can stomach those 20-30% declines, putting in all that money at once. So that's why I highly recommend, again, although I can't give financial advice, that, speak from experience here and stuff, the dollar cost averaging is a great means, not going too heavy, too quick, knowing that the time frame for this recession and therefore recession in asset prices is likely going to be longer than what most people expect. We are likely seeing the end of an era here, an end of a beautiful decade of asset appreciation that made a lot of people very rich. But unfortunately, the good times, I think, as we saw through the peak, through the craze after the pandemic, with stock market speculation on Robinhood, the short squeezes of GameStop stock, and Bitcoin hitting $65,000, and Dogecoin going to the moon, all these things were the indicative visual signs that a cycle top was in, and that we are likely not going to return to that kind of euphoria for a long period of time. Now, we wrote about this in the Dash report over the past few months, and over the last few letters we've wrote each month, it's really been building into this idea of what environment we're in right now. And we've been really preparing ourselves as a community for this move. It doesn't mean that there isn't going to be opportunities. And that's one thing I want to talk about here is we get another turnover here potentially in equities, back down to potentially new lows. That is going to drag crypto prices down. That's going to drag Ethereum down irrespective of the merge. It's going to drag down Bitcoin. And on top of that, it's going to drag down the total altcoin market cap. But the good news is here is as altcoins go from around a $300 billion market cap or $325 billion where they were back here in early August down to potentially $200 billion or maybe even down towards $150 billion, somewhere maybe down into new lows, we're looking for value opportunities. We're looking for the next big thing. And I think we've got a project on our radar that could very well be one of those. And that is Radix. So we're going to go ahead and dive into our sponsor review of Radix. And I want to talk to you guys a little bit about why I really like the project fundamentally. And on top of that, some of the really exciting developments coming down the pipeline for the protocol as it goes through its stages of development. Alright everyone, so to kick things off here, we've first got to go through what Radix is all about. For those of you who haven't heard me talk about Radix just yet, Radix is a very exciting Layer 1 DeFi focused protocol that's aiming to radically change the game for how people develop and utilize DeFi applications. Now, I highly recommend you guys dive through Radix as a protocol, do some due diligence outside of what I talk about here today, especially if you're considering potentially looking into the project and getting involved. But simply put, one of the biggest things to understand about Radix is its focus on completely building from square one and starting to build frameworks that allow people to build full stack DeFi applications. Completely different in the format that they're used to building in Ethereum or other Ethereum virtual machine compatible environments like Avalanche, etc. Now, it's important to understand overall why Radix is incredibly different, and its biggest differentiator is its focus on developers. Over the past few years, while we have seen DeFi and NFTs doing quite well and starting to find market traction to a degree, while these applications are exciting, they've been heavily limited by the restrictions of the Ethereum virtual machine and Solidity, core language utilized to program smart contracts that allow for really exciting applications like Uniswap. But even something like Uniswap takes thousands upon thousands of lines of code where developers are not so much spending time just developing, they're spending time auditing it to make sure that things are safe, because these applications require that they be audited and safe so that funds don't get stolen from the protocols. And once you build something that works, it usually works. But the unfortunate thing on top of that is that you usually find that these protocols are limited either due to their lack of scalability or on top of that as well the developer flexibility to really build unique applications that just unfortunately aren't really possible with the framework that Solidity and Ethereum offer. But there's some really exciting updates that Radix offers through Scripto, its native programming language, and some of the upcoming updates that are going to allow for the manifestation of value through the Scripto native programming language that originates around Rust. Now, one of the big things I wanted to share real quick before I talk about my personal thoughts about that vision long term that I think are quite exciting about Radix is that there's a couple different updates. Radix has been pretty busy since our last update here on the channel. They had their inaugural Jersey Decentralized Finance Summit. As many of you might know, their core company or entity around the token is based in Jersey. That's a pretty popular region for the crypto space, but they had one of their annual meetups with the team back in June. They talked a little bit about the vision of Radix as a company. And on top of that as well, they had their Scripto Dev Swarm event with over 250 developers live from over 5 cities contributing, testing out Scripto, trying to see what they could build with the language and the overall protocol. And on top of that, Pierce has been making the rounds, as many of you may already know. He's the CEO of Radix, coming out and actually even speaking at one of the FinTech executive forums for AWS. This is very fitting with what we're going to be talking about here throughout this segment, as I think there is a big correlation with what Radix is offering for DeFi to AWS. And for those of you who work in IT or software development, you'll know that that's a pretty big claim. So give me some time. I want to try to explain why Radix, I think, is positioned in that way. So first off, a couple other last pieces of news here. The fact that Radix is going to be, they actually just recently were speaking at Mainnet in New York back here on August 12th. Again, Pierce and the team have just been continuing to crush it, going throughout the country and throughout the world. And on top of that, they also hosted as a sponsor at Token 2049. Again, another huge crypto conference hosted in Singapore. So Radix is going really all over the map here when it comes to their events across the world. But even putting that aside here, I want to go ahead and talk a little bit about why I'm excited about Radix. I think that's why you guys are here watching the video. You guys want to hear my candid take about why I like it as a project. And yeah, look, I want to be very candid, guys. They're a sponsor here on the channel, but we only do sponsors in the channel that I like, and Radix is one of our long-term partnerships because they're one of the few protocols that I actually find genuinely exciting in crypto. And here's why. When we really look at the grand scheme and vision of crypto, and even what we were talking about today in our video about the lack of innovation that's going on right now in the crypto space, it really didn't feel that way back a couple months ago. You know, we had really what many people would define in traditional technology or market speak, they call it the hype cycle. You have this new promise of technology. You have this idea of new technologies like NFTs or decentralized finance. You have your first few applications. You have the Bored Apes Yacht Club for NFTs. You have Uniswap and Compound and Aave. These really exciting applications where if you're really into crypto, it makes a lot of sense for you, and it can come across as very exciting at the get-go. But then you start to quickly realize, after about a year of that excitement, that innovation has stalled. Not many new applications are being built. And on top of that, no new users are really coming. In fact, you might even start to see negative growth. And these are the kind of problems that have plagued the crypto space, mainly due to the limitations of the first legacy wave of technology. Networks like Bitcoin or Ethereum. And while each network, going from Bitcoin to Ethereum, has arguably provided more functionality and therefore more value to build exciting applications and engage more in these concepts of DeFi and NFTs, the problem that you run into is that that limitation is stalled due to some very big problems in the way that things are done. And if we understand the limitations of Ethereum, the developer complexity of building applications in Solidity on Ethereum, the time to actually developing applications, and on top of that as well, the overall friction-based user experience of engaging on the Ethereum network. And while I'm a big fan of Ethereum in a lot of ways, I have a lot of positive things to say. I've built apps on Ethereum or built crypto wallets around Ethereum. To be honest, there's a lot of issues. And a lot of the time where developers should be developing applications, they're unfortunately worrying about whether or not their code's secure. Users who should just be able, like as smooth as butter, they should be able to just do transactions, are worrying about whether or not the funds they put their money on are going to get hacked. And this has been commonplace in the crypto space, part and parcel of crypto. Whereas Radix, on the other hand, is offering a completely different framework here. Now, I'm not going to say it's perfect. Radix doesn't claim to be that, and they don't have a solution that's going to be released overnight. It is going to be something that is slowly but steadily rolled out, similar to projects like Cardano that have a long-term vision of what they want to entail and build. And Radix, through its utilization of Scripto, an asset-oriented language, which is a different framework of how interactions are completed within the Radix engine versus the Ethereum virtual machine and other layer ones, as well as its focus here on being able to dramatically simplify the language, the implementation of blueprints or sort of components that are reusable and easily able to plug into, and you want to build complex applications that build on top of them. These kind of tools are going to allow for Radix to attract a whole new wave of developers and streamline developer time to get applications up to running and actually being able to be utilized by everyday people that are much more easier to understand, easier to audit, easier to trust, and understand the security of, and on top of that, be able to build applications the likes of which we haven't seen yet. And this is where, again, I go back to really the dot-com bubble. When you had the first wave of the internet, similar to this hype wave we had of DeFi and NFTs, we knew something was good. We knew that there was something down the pipeline. But unfortunately, as with all great innovation, you go through the hype cycle, you go through a period of drawdown, and I think we're going through that right now. But in the long run, we are going to have our catalyst moment. We're going to have that moment where things change, where all the frictions that existed in the past start to clear up step by step. And whereas in the past we have the internet, AWS, or Amazon Web Services, one of the major cloud services today, it's the only reason that Amazon, ironically enough, is break-even or profitable today, is because of AWS. Due to the server IT solutions that they offer for businesses, startups, technology companies, that during that period of time allowed for a Cambrian explosion of mobile applications and major websites to come to the forefront. You have, websites and applications like WhatsApp and Snapchat, dozens upon dozens of applications that were able to be built during this period of time because of streamlined solutions like AWS. And what I think AWS did for Web 2, like the traditional web infrastructure and the internet in general, mobile applications, I think as well Radix has a very good chance to do for DeFi and NFTs. I think it has the ability to be able to remove all of those friction points and be able to get to the cusp of what's causing all these issues for people that are preventing them from being able to actually build value in DeFi and do what I think everyone really wants to see, which is bring DeFi into the real world. I think everyone started to realize slowly but steadily, if you really take a step back from everything, how much of a circular, kind of machine DeFi is. All of it was just internal capital and liquidity getting circulated around in our little crypto environment, which really is seen as a laughable environment by traditional finance. Until you're really willing to bring in the big boys and bring in the liquidity, for that matter, and the applications that are going to be tied to that due to all those new assets and dollar-based liquidity, we are not going to see DeFi growing in value. That's the simple case. And to be honest, I know a lot of people have hesitation against the traditional systems, but to be honest with you all, look, unless you're not using a bank, unless you're not using anything from the traditional financial system or engaging in investing in equities or everything, then we can't speak negative about it because there are valuable components of traditional finance. The biggest problem is that there are inefficiencies within that traditional system in the things that we want to access. And Radix can start to fix these things. It can start to serve as a bridge between DeFi and CeFi. It can start to serve as the infrastructure for Web3 and DeFi and start to allow us to build applications we just haven't seen before. Now, in today's video, I won't be able, as with these reviews, to go through all the details. I won't be able to dive through the white paper and all the resources that you guys should dive through if you really want to see what Radix is all about. Do not just take my word for it. Do not fall blindly into it. I want you guys to actually go out there and look into it, because for me, I've gone through and looked at hundreds of different crypto protocols. It's a pretty cool feeling coming back home and stuff, and being in the room I was starting the channel in 2017. Because I can tell you all, I've been through hundreds of projects. I've seen a lot come, I've seen a lot go, and I've seen what leads projects to succeed and fail. And Radix started off the right way. They didn't rush into it, and they focused on one very big element. They spoke with developers, and they asked them what kind of problems they were dealing with. And once they had that information, they were able to figure out what to build. And I can't tell you guys how many protocols I've seen who build a great solution and expect people to come, and they never took a moment to ask their target market, the people they're trying to help, who are trying to create value and want to build community and value, taking the time to listen to them. And that's the best way you find product market fit. And when you find product market fit on one of these big opportunities, that's when it gets incredibly exciting. I can't guarantee to you guys Radix is going to go up in any certain degree on price. You've probably noticed I haven't even talked about price this entire time, because this isn't a play that I worry about buying at the specific price. And it's not even something that, again, you have to invest in. Maybe you just want to develop on top of it or utilize the applications. But this is where the important stuff comes in. When we understand the next coming steps for Radix, there's a couple major steps that are going to be coming down the pipeline here for Radix in the long run. And I definitely recommend you guys continue to keep in touch with the blog and their knowledge base, and even check out the developer section as well, because there are a couple major things that are being coming up as Babylon comes up into release. Now, there are a couple different phases of Babylon that are going to start to manifest the value creation of Scripto. Now, there is the AlphaNet, which is going to be coming up here quite in the near future, and this is going to allow for people to really start to test more extensively with Scripto and start to experience at a deeper level what many people have been able to experience in a test-based environment. But what comes up next after that is incredibly exciting. Next up for Radix, what you've got coming up is the BetaNet, which is going to be released later on in December. And when that comes out, we are going to start seeing people through the utilization of APIs, and on top of that, a finalized framework for Scripto and other network-based features that are essential for really deploying and building these applications. We are going to be able to see Scripto in full force. We're going to be able to see what it's like for applications like Uniswap that usually were tens of thousands of lines of code to be built on Scripto, on the Radix engine, that only take a couple hundred lines, probably around 200 to 300. It's going to completely change the game for developers. It's going to be less auditing time. It's going to be more deployment, more value creation, more experimenting, trying new things, not getting bottlenecked by the same applications, and hoping and praying that you've built this simple engine or this simple application that is already on a dozen different chains, just to do the same thing. There people are going to be able to build really exciting things on top of this. And I don't think we exactly know what people are going to be building yet. But I highly recommend you guys, if you haven't already, to look into the protocol. Give it a chance. Take a look at it. It's one of the most exciting projects. It's one of the few altcoins that I'm actually looking at in this bear market. And I think that you guys are really going to find an interest in it. So check out the link down below in the description. If you've made it this far listening to all my rambling, hopefully you guys got something out of this video. Consider dropping a like. It's one of the best ways you guys can support the channel. But until the next video, everyone, I'm losing my voice. I'm going to go ahead, spend some time with family, enjoy my travels. I hope this video proved valuable for you all. But until the next one, have a wonderful rest of your day. Have a great weekend. And I'll see you all in the next video. Take care, everyone.